Medical insurance can be confusing, especially when it comes to terms like the donut hole. So, what exactly is the donut hole in medical insurance? The donut hole is a coverage gap in Medicare prescription drug plans. It occurs when your total drug costs reach a certain limit. In 2021, the donut hole starts when your total drug costs exceed $4,130. Once you reach this threshold, you enter the donut hole. During this stage, you are required to pay a larger portion of your prescription drug costs. Typically, you'll have to pay 25% of the costs for brand-name drugs and 25% for generic drugs. The donut hole continues until your total out-of-pocket costs reach $6,550. Once this limit is reached, you enter the catastrophic coverage phase. In the catastrophic coverage phase, you only pay a small coinsurance or copayment for prescription drugs, for the rest of the year. It's important to note that not all Medicare drug plans have a donut hole. Some plans offer additional coverage that helps to reduce or eliminate the coverage gap. Additionally, the donut hole is specific to Medicare Part D, which is the prescription drug coverage program. It does not apply to other types of medical insurance plans. The purpose of the donut hole is to save money for both beneficiaries and the Medicare program. However, it can be a significant cost burden for individuals with high prescription drug costs. Understanding your Medicare plan and the donut hole is crucial so that you can plan for potential out-of-pocket expenses throughout the year. Now that you know what the donut hole is in medical insurance, you can be better prepared to navigate your coverage and make informed healthcare decisions. Medicare beneficiaries pay a monthly premium for Part D plans provided by private insurers to cover prescription medication costs. Up to a set limit, the insured person pays some costs out of pocket while the plan covers the rest. This is the initial coverage phase. After one's total drug spending exceeds that initial limit, there is a coverage gap where the beneficiary must pay a larger share of costs out of pocket. This gap is the donut hole. In 2022, the coverage gap starts after $4,430 in total drug costs, including both the plan's and individual share, and ends when out-of-pocket costs hit $7,050. While in the donut hole, the beneficiary gets a discount on brand-name drugs and pays no more than 25% of costs for generics in 2022. But costs are still higher compared to the initial coverage phase. After reaching the end of the coverage gap, catastrophic coverage kicks in where the individual pays only a small coinsurance or copay for the remainder of the year. The Affordable Care Act has been steadily closing the donut hole. It will be phased out completely by 2025, so coverage becomes continuous.